Okay, folks, this is one of those topics where it's a very vast subject, so I'm introducing you slowly into one of the most important time frames of the 24-hour banking cycle. The London Open is typically a time where I like to trade because it gives me a lot of opportunities, and its magnitude is a lot more favorable for a short-term trader. It comes with it a great deal of responsibility in terms of knowing what the higher time frames are doing. A lot of economic calendar releases come out overnight and they can be very volatile. But the euro dollar and the British pound pairs are ideal for this time of day, and that's why I've elected to trade those two pairs. The London Open frequently sets up an optimal trade entry pattern that can offer 25 to 50 pips for a scalp. The key times to monitor are 2 a.m. to 5 a.m. New York time. So in other words, the easiest way to avoid me confusing you about the time is determine whatever time it is in your area relative to what it is in New York time. Okay? And physically wait for 2 a.m. to be in New York and then calibrate that with your broker and your local time. And always set a clock for New York, and you'll know exactly what I'm referring to in terms of time. It's the easiest way I can overcome that barrier because it's been a point of confusion many times because I don't know where you are globally, and you're all in different locations of the globe. I don't know what the translation is going to be in terms of time, so the conversions are going to be up to you. But the ideal ICT London Killzone for your learning is going to be 2 a.m. to 5 a.m. and it's relative to New York time. Now, if you look at this chart here, this is a euro dollar chart, and what I'm highlighting here is two specific trading days, and I want you to take a look at the red. It's like a deep red vertical line. There's two of them. Immediately to the right of the leftmost vertical red line, we see price action drop down initially, and then it rallies up, and it creates the very high of the day. The day's low forms down here, and it comes off the low and closes off the low. The next trading day, again, here is the vertical red line, and this delineates New York time, midnight. Okay, so midnight in New York, that's what this vertical red line delineates for this particular day, and this represents midnight in New York on this trading day. So we can see that the price rallies again for the euro dollar up into this small little segment of time, and it creates a high and trades down, creates the low of the day later on, then goes in consolidation and closes in the middle of the range. The key takeaway that I want you to more or less be encouraged to go through your charts and study is that London Open generally has the highest probability of creating the high or the low of the day. So here we see price trading up to, and this little blue line segment and this little blue line segment is just delineating that little pocket of time, that window of opportunity between 2 o'clock in the morning and 5 a.m. New York time. You can see how beautifully it goes up, trades, makes the high of the day, and then trades aggressively lower. Same thing here on this day. It trades up, spikes up, creates the high of the day, and then sells off. Okay, this is one of the biggest things that a lot of students of mine and people that have just casually looked at my things in terms of my tutorials, this is one of the biggest, well, in my career, it was the biggest discovery because it helps me determine where, when I'm bearish, the actual high of the day is going to form. And if I can do that with a reasonable measure of accuracy or consistency, just imagine if you could get 3 to 4 opportunities where you can get the high or very close to the high of the day and ride the majority of the daily range. If you could do that a few times a month, you could do exceptionally well as an FX trader. Now, it doesn't limit itself to just Forex. This same phenomenon occurs in other assets. Now, I don't trade Bitcoin or cryptocurrencies, but I have students of mine that swear by this working in that asset as well. It works in commodities, it works in bonds, it works in just about everything that trades electronically overnight. Incidentally, you can anticipate things like this to occur in index trading. So if you're trading, for instance, the DAX, the FTSE, or the S&P 500 or Dow or NASDAQ futures contracts, overnight trading, you can see the same phenomenon occur as well. So it really isn't limited to just Forex. Now, because I taught it to the trading community, they assumed that it was limited and only salient to Forex or foreign exchange. I used this same concept as a commodity trader in the early 90s. So it's not that we have an asset class that it can only function in with this type of trading or this type of price action. It's completely universal, and that's pretty powerful. Now, if we have a market that is, let's say, in a strong trending environment, you want to be really focusing in on London because London will give you the highest probability of a low risk entry price point. Okay, and conversely, we can see when the market is bullish, the tendency is for the market to trade down, creating the low of the day in the London Open ICT Killzone. Again here, market trades down after midnight New York time, creates the low of the day between 2 o'clock and 5 o'clock in the morning New York time. Low of the day forms, off to the races we go. So here's 2 back-to-back trading days. Okay, if you could have taken a long, not even at the low, okay, say you use some of a, I don't know, maybe a buy stop to get in. Okay, if you trail a buy stop above these individual candle highs and eventually it trips you in, gets you long, and this held on to it for 30, 40 pips each trading day, it adds up quickly, folks. Same thing here. Market creating a low, takes off aggressively. Now, I want you to take a look at the relationship between one London Open low and the immediate day after London Open low. Okay, we have a range that's framed by the low here and this highest high in between the 2 London lows. This is your trading range right here. And this would be an optimal trade entry long using previous days data to today's London setup. So you can get an optimal trade entry on that, and price does an expansion on the upside, and we can see a very nice opportunity to have a long trade on both days here, focusing on London Open, creating the low of the day when the underlying market is poised to go higher. So the London session itself actually trades a little bit longer than 5 a.m. Okay, but for the sake of my concepts, I want to graduate over time the significance of 5 o'clock in the morning New York time to 7 o'clock in the morning New York time, which is classically like a London lunch period where it can go quiet, it can have minor little retracements, but I don't like to see any type of entry between 5 o'clock and 7 o'clock in the morning New York time, because it can tend to wait for the New York Open, which we'll cover in our next lesson. But the price action during the London session sees the highest probability of a large directional move in the 24-hour day. So what does that mean? If we were to look at the entire 24-hour market and pick a beginning point and followed it around the entire world, and where it began, it'll end. So we have 24 hours of time. If we were to measure the volume, or how much action, if you want to call it any other word, it's layman's terms, the most bang for your buck is going to be in the London Open. Now, that right away draws excitement to younger guys, and if you don't know what you're doing, you can get really hurt quick in the London session because it can be extremely volatile and it can be like a lightning bolt. Okay, if you're caught on the wrong side of the marketplace and there's a high impact news event that's out during that time frame, you can get mowed over rather quickly. And if you don't use stop loss orders, that session is going to treat you very cruelly in the form of taking money from you, because London can be extremely one-sided, and once it takes off, it's pretty relentless. It doesn't really give you a chance to get off the hook. Now, the London trading session actually extends beyond the 5 a.m. hour to 7 a.m. New York time. The London session sees the highest volume of order execution than any other trading session. If we look at the little chart to the right, and again, all I'm trying to do is show the profile itself. We don't need to zoom in and look at details of wicks and candle bodies. I just want you to look at it graphically in terms of the way the ranges expand and how it looks overall. So we have trading day here. We have consolidation. It creates a little bit of a run up, rejects that, and trades aggressively lower, and then comes off the low and begins the New York session. So we have a micro power 3 formation in here. So we have the open, the rally up, the expansion, the low, off the low it closes. Okay, price is fractal, folks. We can anticipate seeing duplicate patterns that are seen on higher time frames on a lower time frame. So if we understand that the daily range, if it's a bearish market profile or if we're looking for lower prices, the opening on the daily range or daily bar is going to be at or near the high of the day. The high is going to be very limited in terms of how much it goes above the opening price. And then the largest portion of the range is going to be between the open and the close is going to be near the low of the day. Well, this is intraday price action between this vertical line here and this vertical line here. This is delineating 2 o'clock in the morning to 7 o'clock in the morning New York time. Okay, so we're looking at a window of 5 hours. So if we understand that price can be fractal and we're bearish, this could be viewed as a micro power 3 formation. Okay, now why is that significant and why should I be teaching it to you? What's the point of it? Well, if we see in this trading day here, it creates a scenario where, let's assume for a moment that we were anticipating a bullish market move. Okay, maybe this particular day it traded down to a level that was some kind of a support level, and we came off of it, traded consolidated, okay, and then we came down initially right after the 2 o'clock time period, and price drops down into a significant low. If price doesn't start to run there during the London session, we could reasonably expect that the real move is going to be in the next trading session, which would be the New York session, which is not going to be our teaching here. It's the next lesson in this series. But you can see the move ensues after the crossover from the London session and then the beginning of the New York session. Now, the London session technically extends even beyond 7 o'clock in the morning up into 10 to 11 o'clock in the morning New York time. Okay, so basically it's 3 o'clock in the morning New York time to 11 a.m. to noon, all relative to New York time. Okay, so there's an overlap of New York and London trading, which makes the next teaching a little bit more interesting as well. But the takeaways I want you to have is that the London session can create the higher low of the day, and we can also study the profile that takes place in between the beginning and ending of the overnight session. If it's trending, okay, if we have a trending model like this, chances are we could see a rather quiet New York session. It doesn't mean that always, but it's one way I like to look for potentially a slow New York session. Or we could have a reversal scenario, which is what we saw here. Okay, to the right of this vertical line is the New York session. You can see it did have a little bit of reversal, but it went consolidated and basically traded in the middle of the overall range and did a close. The very next day, we had an initial drop down in London, creating the low of the day, but it closed the session right in the middle, so it didn't really have much of a trend. It had a spike low, but if we're bullish, it didn't really show any kind of indication that in the London session. But as soon as we crossed over into the New York session and overlap with London, then we have the optimal trade entry, then we have the dynamic imbalance where the range expansion occurs for the daily upside and up close. So London gives us a lot of things to study, and I want you to go through your charts and look for examples of the things I just outlined here, and I think you'll be rather surprised. Okay, the London session characteristics. Now, the London session typically creates the low of the day when the market is primarily bullish and the high of the day when bearish. When the market is poised to trade higher on the daily time frame, we can focus on the London session to post the low of the trading day. If the daily is poised to trade lower, we can focus on the London session to post the high of the trading day. And what I've done is, instead of putting the Fibonacci on the chart and cluttering it all up, I just basically drew a line indicating the high I'm using and the low I'm using. Now, I'm not using the body-to-body reference points because it's a daily time frame, and I want to encapsulate the entire range with the wicks included. It will not change what I'm going to show you here. So if you have your daily time frame on your euro dollar, you'll see that it will still take us up into optimal trade entry, which is basically a non-indicator form of overbought or oversold. Okay, so what we're seeing here is the market on the euro trading up into the 70.5 level, failing to get to the 79 level, and this candle right here shows a willingness to want to reverse. So the next candle, we could potentially see this be a bearish candle. Now, I'm not looking at swing points. I'm just looking at in terms of where we are in a higher time frame, and this could be a point of interest for a breakdown. Okay, so once we have a bearish candle like this, and we're inside the area of optimal trade entry for a sell, or what would be deemed as a potential sell, the very next candle, we want to study that because it may give us a condition that frames a power 3 formation with a down close relative to the daily chart. Okay, so we have this particular day here, which is the 28th of November, and we have the market trading sideways until midnight in New York, and then we have the market initially drop down. We do not worry about that. We want to see it rally up into London Open. It starts this area right here. It's dropping here. We don't want to see that. We want to see price rally up. That's where we'll sell. Notice also that we have equal highs in here. Okay, about 10 pips above this short-term high. That gives us the high of the day. At the same time, we would reasonably expect to see London Open create the high of the day. Why should the daily bias be bearish? Because it's been going bullish here. Well, we traded into an area of optimal trade entry, and we got one candle showing a willingness to reject and go lower. So we want to look for characteristics like we're seeing here, the open, and then a rally above. We can look to be a seller there after it takes equal highs out. So we have a Candyland, buy stop liquidity pool. Okay, runs up, knocks the stops out, and then trades aggressively lower. Creates the low of the day. It comes off the low of the day and trades at or near the low. So in relationship to power 3, if we're looking at this price action here, you can see that would be the daily range. So we can see that the opening, it's a very limited upside movement above the opening. That's this little portion of price action here. It creates the high of the day during the London Open Killzone between 2 o'clock and 5 o'clock in the morning. Dynamic imbalance or range expansion for the daily candle or bar, creating the low of the day right here. Then we come off the low, trading near the low of the day and closing right here. So this is this whole candle right here. This is what it looks like in a open, high, low, close format.